Hello, I'm Noelle Lim on ASEAN Speaks, Maybank Investment Banking Group, bringing you the highlights from our research team in their Monday briefing. Inflation dominates the headlines as central banks scramble to catch up. After the Fed's FOMC meeting and the MAS surprise inter-meeting, how should investors position themselves in the bond markets and what Forex strategies should they consider? And where can we seek shelter from inflation in Singapore equities? Suhaimi Ilias, our Group Chief Economist, discusses with the team.
Monday, 31st January, we had epic Sunday tennis with Rafa Nadal winning his second Australian Open to accumulate a record 21 Grand Slam titles. But last week was really and largely about Fed, not Roger Federer, but US Fed. US equity market in corrective territory, down over 10% from recent highs, and US Treasury yields increased in response to the hawkish Fed signal from last week's FOMC meeting and statement, pointing to the start of interest rate hike at the next FOMC meeting on 14-15 March. Volatility as measured by the volatility index reached its highest level since the early month of the pandemic, largely driven by fears that the Fed is behind the curve and need to raise interest rate quickly to tame inflation. The futures markets at the end of last week were pricing in a significant potential for 125 basis point hikes in interest rates this year. Market was also focused on Fed's plan to reduce its balance sheet, i.e. quantitative tightening or QT, by selling its holdings of treasuries and agency mortgage-backed securities. Fed Chair Powell said that policymakers were discussing how a balance sheet reduction would work, but that he expected to announce more details following the March FOMC meeting. The chairman also acknowledged that the Fed's roughly almost $9 trillion balance sheet is substantially larger than it needs to be, making a substantial quantitative tightening of QT likely. I think just to highlight from last week's FOMC meeting, I think on QT, there was no call on quantitative tightening. Clear signal interest rate will start in March, but QT is on the card as Fed shares some guidelines. QT will commence after Fed fund rate hike has begun. Fed will communicate on the pace of quantitative tightening, and in the longer run, Fed intends to hold primarily US Treasury securities. In any case, I think there was also the release of the first estimate of US 4th Q 2021 GDP growth that showed the US economy grew at annualized rate of 6.9%, well over consensus 5.5%. For the whole of last year, economy grew by 5.7%, and that's the fastest since 1984. But high-frequency economic indicators suggest some slowing in January. The US composite PMI flash release for January fell to 50.8 from 57 in December, its lowest level in 18 months, indicating impact on the economy from the spread of Omicron variant of the coronavirus. The January's flash has composite purchasing managing indices for other major economies also slipped. For EU in January, it's down 52.4 from 53.3 in December. For UK, the number was 53.4, slightly dropped from December's 53.6. But for Japan, it dipped below 50 in January to 48.8 from December's 52.5. And Australia also similarly posted a drop in its composite PMI to below 50 to 45.3 from December's 54.9. Overall, suggesting slower start to 2022 versus end of 2021 in terms of world economy. And last week, IMF World Economic Outlook update trimmed global real GDP growth to 4.4% from 4.9% previously, in line with our 4.5% forecast made in December, mainly reflecting downward revisions to the US and China growth for this year. International crude oil price pushed to 7-year high, above $90 per barrel, briefly, driven in part by the concern about developments in Ukraine border. This geopolitical event, I think on top of US Fed's policy normalization, has caused shares in Europe to register fourth consecutive week of decline. In contrast to hawkish Fed, Bank of Japan governor reiterated the central bank's commitment to ultra-loose monetary policy, but Monetary Authority of Singapore surprised with a policy tightening in between scheduled policy reviews in October and April. So for today, we have Winson and Andy to talk about implication of last week's US Fed FOMC meeting on bond and currency market. Hak and Thilan to touch on the macro and equity market following Monetary Authority Singapore surprise policy tightening and upside to inflation and Singapore dollar. And then we will have Yuwanee and Vanida to chat about Thailand's healthcare and property sector. Let's kick off with Winson. Winson, given the rate hike and quantitative tightening signals from last week's FOMC meet, what's the implication to your bond market outlook? Are there any changes, especially in terms of yields and market calls for US Treasury and ASEAN govies?
Hi, good morning, Suhaimi. Yeah, I agree that the Fed has been behind the curve for quite a while because QE should be zero at least 6 months ago, and they should have started raising interest rate by now, given how strong the labor market condition in the US. And I think that currently the urgency has clearly shifted to tame high inflation. Entering the rate hike cycle, a typical move for the yield curve is for the front end to continue heading higher. We have been forecasting higher 2-year US yield 1.25, which is already about there. So we are actually raising our 2-year US Treasury yield forecast to 1.5%. But at the back end of the curve is actually a bit more tricky, a bit less certain. We are keeping it at 1.9%. Why? Even though the Fed is turning more hawkish, the Fed hiking 4 times, 5 times, 6 times, or 7 times in 2022 doesn't really affect our views on the 10-year US Treasury yield by much, because it is the terminal Fed funds rate that matters more to the long end yields. It's not really how quick the Fed will hike rates in the next few meetings or in 2022. I think when it comes to the so-called terminal rates, the Fed guidance is still at about 2.5%. For the 10-year yield to move substantially higher, I think they need to change the terminal rate guidance. That would be interesting if they really change it, because they are actually currently tightening into the well past the mid stage of the US economic cycle. So we have some concern as in how quick, as in how far the Fed can tighten. In this cycle, we expect a compressed Fed tightening window. That means faster rate hike, but may not be for long. So we still expect the flattening of the yield curve. At the beginning of the year, we expect it to come down to 65 bips from about 100. It has flattened surprisingly fast, I would say. And we have a wildcard, which is late cycle pricing on the shape of the yield curve. That means 25 bips and below. We are still keeping it. But there's still a risk to the shape of the curve. That is QT, quantitative tightening. If they go aggressive on QT, that could actually steepen the curve.
What about the view on ASEAN govies?
For ASEAN, we look at 3 countries, mainly Singapore, Malaysia, and Indonesia. We also changed our view to be more neutral. For a number of these markets, we have been sitting on the bearish call for quite a while. Obviously, Singapore is quite highly correlated with the US. We have turned more neutral on the US Treasuries, so we are also shifting our outlook on Singapore to neutral because it largely tracked the Treasury movement. I still forecast 10-year SGS yield 1.9% by the end of this year. Malaysia, I think the market is well priced for a moderate BNM rate hike over the next 1 to 2 years. Market pricing is currently applying 2 hikes in 2022, another 2 hikes in 2023, which I think is fair. And this year, even though there might still be Treasury volatility, but I actually expect MGS to outperform. And that means when I compare the 10-year MGS versus the 10-year Treasury yield, I expect the spread to continue to narrow. I forecast 10-year MGS yield 3.65% unchanged. Current level is slightly higher, but we think by end of the year, it can actually come down back to this level. Whereas for Indonesia, I would say we are slightly cautious because rupiah bonds have benefited significantly from Bank Indonesia purchase of government bonds. So in a way, they're actually more exposed to the risk of faster US Fed tightening. And in the last meeting, as we know, BI has already mentioned they are going to hike the reserve requirement ratio in March, June, and September. So essentially, this opened the door for them to hike rate if needed. So we expect BI to hike rate by 3 times in 2022 and the Indo GB curve to bear flatten. The 10-year yield, I'm expecting it to be around in the range of 625 to 650, but in the near term, probably towards the higher end.
Thanks, Winson. Andy, apart from Fed's tightening cycle, we have Omicron, we have outlook of multi-speed global monetary policy normalization on the back of macro divergences. We got commodity plays, we got geopolitics. All these are affecting FX market. How do we navigate the FX market under this cross currents, crosswinds, in terms of strategies based on all those currency moving themes?
Thanks, Suhaimi. Very good morning, everyone, and happy Chinese New Year coming tomorrow. So Suhaimi, we shared in our recent report the potential 5 strategies that we can take. Opportunistic plays can be strategic beyond 3 months, some tactical up to 3 months, and technical up to 1 to 2 weeks. Essentially, there's a lot of thematic and a lot of factors driving currencies now, and currencies typically move ahead of some of these plays. So let me briefly go through these 5 categories. One is the reopening plays, the COVID endemic and reopening sort of story. Singapore, Thailand, and Korea have adopted that COVID endemic and reopening policy stance. So actually, in that respect, there's a good chance for currencies such as Sing Dollar, Thai Baht, Korean Won, in our view, to outperform currencies like Taiwan Dollar and the CNH in 2022. So if you look at it from a trade-weighted basket perspective, trades, we would actually suggest going long Sing Dollar, Thai Baht, and Korean Won versus relative to going short CNH and Taiwan Dollar. This actually reflects our view in terms of the COVID endemic sort of policy, relative play between the countries. So something to look out for. On the second play is the G7 against China divergent play. I think we're seeing China struggling to support growth and ease the gains in terms of traction or on that front and domestically. We also note that the Fed's hawkish shift, even some houses are calling for 4, 5, and some are even 7 moves this year. So we turn attention to also other hawks in the Asian region which have slipped under the radar, which is New Zealand, Bank of England, and Canada. So if you take all that into consideration, we are actually positive for long, would suggest going long on currencies like Canadian dollar, Aussie, and Kiwi relative to the CNY, and even to some extent yen. So we would actually look into that as well in terms of G7 China divergent play, particularly against CNY and yen. Third is the commodity thematic. We've actually looking at it glass half full sort of approach for 2022. We're looking recovery to broaden, even as growth in some of the major countries have actually peaked. So with factoring some of the geopolitical tensions as well, we are actually positive on Aussie, Rupiah, Ringgit, and Canadian dollar relative to net energy importers such as the Indian rupee. The second last one would be ASEAN policy divergence bias. Just now, Suhaimi, you mentioned about MES, Singapore Central Bank moving. We remain positive bias for Sing Dollar relative to ASEAN peers such as Ringgit and Peso. However, on a technical basis, we think we need to look out for, in terms of from the basket perspective, tactically long Sing Dollar relative to Ringgit and Peso in our view. And lastly, on the dollar side, we would recommend actually on the dollar front in the run-up to the March potential Fed March hike, we would actually suggest overlay the current DXY and going long in the run-up to that. However, we would actually think that some of the long positions would actually unwind after that, because typically what we found is that dollar would actually weaken 2 to 4% on average after the first move. So I think those are our five currency strategies actually to play, given the overlaying different circumstances or different factors that we're going to face.
With regards to these five sort of themes, are they essentially sort of a strategy for people to look into with regards to the currencies for within the next few months, or is it extended beyond that?
Yeah, so some of it are extended beyond that. If you look at the thematics in terms of commodity plays, it's extended beyond that. So we suggested Ringgit, IDR, and Aussie for a thematic play because of the climate change, the transition metals, the geopolitical tensions. I think would be some issues which may lead to upside risk to crude oil prices, and all that will be a bit more longer term. But the short-term ones would be things like, even on the dollar front, it would not last beyond March in our view, because dollar would actually start to decline. So yes, some of them are short in the run-up to March. Some could be even 2 to 3 weeks. For example, some of the opportunistic plays, and some would be even longer beyond into end of the year as well, in terms of growth plays or relative plays. So I mean.
Thanks, Andy. I think in Andy's note, there's a chart that shows a tendency for dollar to kind of go on the run up as we approach the first rate hike by Fed, but subsequent to that, dollar start to kind of ease. Let's move on to Harbin. Harbin must tighten its policy again after the move in October last year, but ahead of the scheduled April policy review. What's the justification for the rare intermeeting move?
Hey, hi, morning, Suhaimi. Yeah, I think intermeeting moves are pretty rare. The last move was actually about 7 years ago, when MAS eased because of the collapse in global oil prices. So you can sense the urgency of why the MAS needed to move. Inflation has been rising far ahead of the expectations. In fact, core inflation just 2 months ago at the briefing, they thought it would touch 2% in the second quarter. Well, by December it was 2.1%. Headline inflation is now 4%. So they've adjusted, I think, the slope by our estimates to 1% appreciation from the previous 0.5%. So this is the second move already from MAS. They've raised the inflation forecast sharply because of this global demand recovery, but also persistent supply disruptions, I think, fueling the cost increases. So core inflation now for MAS has been raised to 2 to 3%. That's a big 1 percentage point move up. We were looking only for a 0.5 percentage point increase. And I think there's price increases across the broad range of goods, energy, imported food, airfare costs, all exceeding original expectations. I would be looking for, I think they're really also concerned more about the pass-through from wage costs into services inflation. So we'll be on lookout for the domestic components, which I think they kind of highlighted as really increasing a lot faster than they thought. So they've also raised the headline inflation forecast, and they highlighted car accommodation costs to remain firm in the near term. The other thing to highlight about MAS change is that they think now the output gap is now positive, as opposed to slightly below zero at the last briefing just 2 months ago, which means that they think that the economy is actually slightly ahead of potential. Which also means that perhaps growth cannot grow as fast, and also means that there are concerns that this will translate into high wage costs. Just to recall that in September this year, they will be introducing the qualifying minimum salary in Singapore at $1,400. That will raise the wages of about 9% of labor force below that minimum salary. And they also expand the progressive wage model to the retail sector in September this year and the F&B sector next year. I think some of this could also compound some of wage cost pressures. So we've also raised our headline inflation forecast to 3.6% average this year, and core inflation 2.7%, in line with the MAS warnings of the high inflation forecast. So come April, I think it's almost a sure thing that the MAS will have to tighten again. So our view is that they will recenter the whole band upwards, even though they moved last week, because the Sing is already trading at the top side of the band. The Sing dollar couldn't really appreciate much, which also means that it can't really reduce imported inflation by very much. But I think come September, they will have to recenter and possibly steepen the slope again. So that will be a pretty aggressive move. So I think it's in line with a more bullish FX forecast for Sing dollar from Andy.
Habin, if inflation is a major worry now, will this affect the upcoming budget? Because there is this expected but inflationary measures, i.e. VAT hikes.
Yeah, so the budget's on 18 Feb. I think there are concerns. I think businesses have come out to say that, please delay the GST hike. We can. A 2% hike would raise inflation headline by another 1.3 percentage points. That brings it, very close to, possibly to 5%, right? If inflation remains persistent. Well, the government has argued that, this should be a one-time hike inflation over 12 months. And, the government's already prepared a $6 billion resilience package to offset the impact on this, especially for the lower income households, which means that even if they raise the GST hike, these handouts would actually remove the pain altogether for them for the next 5 years. So squeeze will probably be more on the middle class, and the high income probably shouldn't feel it as much. I think they will announce it, but the possibility of perhaps delaying it to the second half of this year or maybe January next year. So I think that's a fine line that the government will have to balance out.
Right, thanks, Habin. Thilan, with mass aggressive policy tightening and the outlook of firmer Sing dollar and higher inflation, will this affect your views on Singapore equities? I mean, in essence, where can investors find shelters and what are the pockets of opportunities in such an environment from the perspective of sector and stock picks?
Thanks, Suhaimi, for the question. We still remain positive on the Singapore equities, and we think the market will be an overall beneficiary of rotation out of growth and into value. Now, the higher Sing dollar interest rates, inflation will definitely hurt margins, but for most corporates, it will be manageable. If you look at companies with large overseas income, more than a third in Singapore actually report in US dollars, not in Sing dollars. So there's no real translation impact. The biggest negative from FX mismatches will be in sectors like the REITs as well as the property developers. Lower imported inflation because of a strong Sing dollar will actually benefit sectors like the REITs, telcos, and industrials. Now, the cost pressure we don't really see going down because of central bank measures is actually staff costs, because largely this is a policy-driven supply squeeze. So sectors such as financials, consumer, gaming, tech will all feel this. Finally, we have to look at the higher interest rates, and this will hurt companies with high interest cost burdens. And here we see sectors like the REITs, property, and industrials as the most exposed. On the other hand, if you flip this around, high rates and inflation will actually benefit some sectors such as financials from higher net interest margins, and sectors like the transport, consumer, industrials from higher ASPs. Your question was on where to find shelter. We recommend staying long Singapore, particularly in sectors like the banks, consumer, plantations, transport, as well as tech. Our top 5 picks in the market are DBS, OCBC, UOB, Singtel, and ComfortDelGro. Suhaimi?
Thanks, Thilan. Thailand, we got a couple of sectors to look at. Let's start with healthcare. Yuwanee, you upgraded Thailand healthcare sector to positive from neutral despite cuts in government COVID-19 reimbursement this year. And I think you also cut target prices for stocks under your coverage. So what's the rationale for the upliftment in the sector's call, and which stocks are your favorite?
Good morning. The upgrade is based on more reasonable valuations as share prices corrected heavily year to date due to the potential end of COVID this year, as well as the cuts for COVID reimbursement rates from the government. However, while we agree with both, we think the corrections are overdone. We still like them on their long-term resilient outlook, especially due to the graying population and the limited medical capacity in Thailand. Our top picks are CHG, a social security operator with potentially more public hospital management, and secondly, Mega, the best-selling health supplement brand in Thailand because of its strong brands and reasonable valuation.
Thanks, Yuwanee. Let's move on to Thai property sector, Vanida. I mean, you're staying update on Thai property sectors. What's the latest update on industry's outlook for this year? I mean, in terms of developers' guidance, are there any more goodies from government in terms of policy and measures to boost Thai property sectors?
Good morning. Our update on Thai property sector will be about the sector pre-sale, new launch, earning, and industry development. Firstly, we start with pre-sale. The combined fourth quarter of last year pre-sale of the top developers increased 17% year-on-year and 6% QOQ, driving the full year pre-sale to 220 billion or 5% growth. Supalai showed the best pre-sale growth for fourth quarter, but for the full year, AP remained the market leader with pre-sale of 35 billion or 11% year-on-year. Coming to this year, based on upbeat business plan, we estimate combined new launch of top 10 developer to increase 150% year-on-year. And Siri, SC Asset, AP, and QH are the top developer that target to raise new launch value by more than 100%. Majority of new launch will be landed properties, and because they are developed in phases, new supply will be manageable and will not lead to oversupply, particularly as inventory is now at a record low. For the earning wise, LH, QH, PSH, Supalai will likely see strong fourth quarter earning rebound QOQ. For the whole year of last year, Supalai may see healthiest earning growth of almost 50%. For this year, we estimate the sector revenue and earning growth at around 10 to 13% year-over-year. LH and QH should see more than 20% earning growth. For industry update, the government scrapped a 90% discount on land and building tax starting this year. But we believe the impact is insignificant at less than 0.5% of the combined revenue of developers under our coverage. And extension of the property transfer and mortgage legislation fee cut to 0.01% until end of this year is not a surprise. Coming to the stock pick, our top buy remain LH, target price 10.6 for all business unit. Residential, commercial, and hospitality are likely to show a decent growth this year. Also, we see upside from divestment gain of the apartment block in the US to be settled around mid of this year. We also cut our rating on AP and Supalai from buy to hold for decelerating growth this year to a single-digit rate compared to a high base last year. I stop here. Thanks.
Right, thanks, Vanida. And that's it for today. It will be a short trading week for the Lunar New Year break. Wishing everyone Gongzi Fachai and happy holidays.
To get more details and our research reports, speak to your trading rep or check out market insights on the Maybank Trade app. Happy Chinese New Year and may you have a roaring trading year ahead. I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group.